Welcome back, focused learners. Let's jump right into today's explainer because we're diving deep into a company that honestly presents one of the most fascinating paradoxes in the entire modern market. We're talking about MDU Resources Group. If you're the kind of person who loves dissecting a business layer by layer to see what's actually going on beneath the surface, well, you are in exactly the right place.
Right out of the gate, I want to show you exactly why this stock is so incredibly polarizing. Just look at the sheer contradiction here. On one hand, we've got an 88-year dividend streak. I mean, that is one of the longest streaks in the entire stock market, which usually signals just rock-solid historical stability. But then on the other hand, Wall Street is currently ignoring 9 major financial warning signs, and the stock is trading at a really staggering 22.6 times earnings. So the big question is, are we looking at a legendary income generator, or is this just a value trap waiting to spring?
Okay, let's dive into this. Here's our roadmap for the explainer today. First, an 80-year dividend mystery. Second, 7 hidden red flags. Third, 7 ignored green flags. Fourth, the investing legends test. And finally, we'll wrap up with the final verdict.
Section 1. An 88-year dividend mystery. The context of MDU.
Before we can really analyze the financials, we need to know what MDU actually does. So here are the baseline stats. MDU Resources Group is a pure-play, regulated energy delivery company. They operate across 3 segments: electric, natural gas distribution, and pipeline. And they're serving customers out across regions like the Great Plains and the Pacific Northwest. They're sitting at a market cap of roughly $4.27 billion, with shares trading right around $20.41. Basically, they have this massive, deeply entrenched footprint in the utility sector. You know, an 88-year history doesn't happen by accident. It's built on a foundation of truly essential infrastructure.
Moving on to Section 2, 7 hidden red flags, the bear case. So this bear case is packed with cautionary warning signs that the mainstream financial media just seems perfectly content to ignore. We're going to start with our first 2 red flags, which really hit at the core of the company's valuation. MDU currently holds a Guru Focus score of just 76 out of 100, which is actually below its 10-year median. But more concerningly, it's triggering 9 distinct warning signs right now, including a very weak financial strength subrank. On top of that, its estimated intrinsic fair value is sitting somewhere between $17.33 and $17.70. So at its current price, you're looking at a stock that is 17 to 22% overvalued. Right off the bat, you definitely aren't buying this at a discount. And this brilliantly illustrates our third red flag. Check out this stark contrast. MDU's trailing price-to-earnings ratio is 22.6 times. Now, for a high-growth tech stock, sure, maybe that's completely normal. But for a regulated utility, that is incredibly steep, especially when you realize their 5-year median PE is just 6.6. Think about that for a second. Investors right now are paying more than 3 times the historical valuation for the exact same earnings power.
Red flags 4 and 5 show us that the company is actually struggling to keep pace with Wall Street's expectations. In Q2 of 2026, revenue came in at $375.2 million, which missed the $396.6 million estimate by 5.4%. And looking ahead, their full-year earnings per share guidance midpoint of 97 cents also falls short of analyst expectations by 1.2%. When a company's own guidance starts trailing behind what the market expects, it usually strongly suggests slower growth on the horizon.
The 6th red flag is honestly a matter of pure financial physics. MDU's current ratio is sitting at just 0.78. What that means is, for every dollar of short-term liabilities the company owes, they literally have less than $1, only 78 cents in current assets to cover it. For a utility company that requires massive, constant capital investment to keep their infrastructure running, this is a genuine, glaring liquidity concern.
And our final red flag comes from inside the house. In February 2026, CEO Nicole Kivisto sold over 35,000 shares. On the exact same day, CFO Jason Vollmer sold over 36,000 shares. Now look, insiders sell for all sorts of reasons, we know that. But when both the chief executive and the chief financial officer are offloading significant chunks of their stock at the exact same time, it is a stark cautionary signal to retail investors.
All right, let's flip the script. Section 3. 7 ignored green flags, the bull case.
Okay, let's take a breath here, because that bear case was heavy, but it's time for a pattern interrupt, because there is an entirely different narrative playing out right now that reveals a pretty compelling hidden bull case. Green flag number 1 brings us right back to that legendary number, 88. MDU has paid dividends for 88 consecutive years. That is a 2.65% yield, which works out to 56 cents annually per share. In a market where we see dividend cuts at the slightest economic hiccup, an 88-year commitment to returning capital to shareholders is just incredibly rare and undeniably attractive if you're an income seeker.
Green flags 2 and 3 highlight MDU's real structural advantages. First off, they boast a moat score of 5 out of 10. While that's technically considered a narrow moat, it's actually better than 83% of its regulated utility peers, mostly because of massive regulatory barriers and economies of scale. But second, and this is huge, they have 580 megawatts of data center load currently under contract. As AI and cloud computing drive this unprecedented demand for electricity across the country, MDU has positioned itself directly in the path of this massive structural growth tailwind using a capital-light model. And Wall Street institutions are definitely paying attention, which brings us to green flags 4 and 5. JP Morgan recently upgraded MDU to an overweight rating with a $27 price target. That implies nearly 30% upside from here. On top of that, the consensus from 9 different analysts is a solid buy rating with an average target of $23.88. So the institutional money clearly sees some significant runway here.
Finally, green flags 6 and 7 show a company that is surging forward. Management has confidently reaffirmed their long-term earnings growth target of 6 to 8%, projecting $2.3 billion in revenue by 2029. And the market is totally rewarding them for it. The stock is up 22.2% over the past year, earning a perfect 10 out of 10 momentum rank. So the upward momentum right now is pretty much undeniable.
Let's see how this builds when we strip away the opinions. Section 4, the Investing Legends Test. Objective frameworks.
All right, we've heard the subjective arguments from both the bulls and the bears. Now it's time to apply some cold, hard, objective investing frameworks. We ran MDU through the legendary models of Benjamin Graham, Peter Lynch, and Warren Buffett. And honestly, the consensus is absolutely shocking. It's a unanimous rejection. Graham's defensive model fails MDU because a PE of 22.6 is way above his strict limit of 15, and that current ratio of 0.78 falls massively below his threshold of 2.0. Peter Lynch's growth at a reasonable price model fails MDU because it has a 3.72 PEG ratio, which essentially means the company is nearly 4 times overvalued relative to its 6 to 8% growth rate. And Warren Buffett's framework completely rejects it because MDU's return on invested capital is just 5.74%, which is nowhere near his preferred 15% benchmark. 3 legends, 3 complete rejections.
Bringing it all together now. Section 5, the final verdict, actionable takeaways. So, where exactly does all of this leave us? Let's summarize this intense contrast. So the crucial point is this: your next move depends entirely on your specific investor profile. If you're someone who follows the strict value principles of Graham, Buffett, or Lynch, MDU is a hard pass. The valuation is stretched way too far, and the balance sheet liquidity is just way too tight. However, if you are a dedicated income investor or a defensive utility investor, MDU absolutely deserves a spot on your watch list. That 2.65% yield and an 88-year track record are fantastic. But given the current premium on the stock, the smartest play is likely to wait and watch for a price pullback closer to that $17 fair value mark before making any kind of move.
I want to anchor our final takeaway today with this legendary quote from Warren Buffett. Price is what you pay, value is what you get. MDU Resources is a solid, highly regulated utility with real physical infrastructure and an incredible dividend history. But at over $20 a share, with a PE north of 22, you are currently paying a severe premium for a company that is actively wrestling with liquidity constraints and slowing earnings growth.
Which leaves us with the most important question of all to end our explainer today. Can MDU Resources successfully execute its massive $2.3 billion growth plan while simultaneously managing its glaring liquidity concerns and declining earnings quality? I would absolutely love to hear your thoughts on this data-driven mystery, so please let me know where you stand. Thank you so much for learning with me today, and I look forward to exploring our next topic with you very soon.